Hey everyone, welcome back to Corporate Decoder, the place where we dissect the financial world, and today we're diving deep into Nocera, Incorporated its latest -1 filing, a document that promises a lot of information about their plans to sell more stock, and let's just say there are some things in here that make you raise an eyebrow. This filing is essentially Nocera's way of telling the public they plan to sell a whole lot of their common stock, and we are going to unpack what that means for the company and for you, the potential investor. And before we get into the nitty-gritty, if you like getting clear, no-nonsense breakdowns of these dense financial documents, make sure you hit that subscribe button. Also, we have a growing community on Discord where we discuss these filings and more. The link is in the video description below. So what we have here is a preliminary prospectus from Nocera Incorporated. This is part of a larger S-1 registration statement that they're filing with the US Securities and Exchange Commission. Or the CC, the core of this document is about offering up to 45 million shares of their common stock for sale. Now, where do these shares come from? Well, they're actually linked to something called Series B convertible non-voting preferred stock. Basically, someone bought this preferred stock and now they want to convert it into common stock and then sell that common stock to the public. And get this, Nocera itself is not going to see a single penny from these sales. All the money from selling these shares goes to the selling stockholder, which is an entity called AW Digital Asset Opportunities, V8 LLC. This offering is for 45 million shares of common stock. Importantly, Nocera states they will not receive any proceeds from this sale. This means they are registering shares that are already owned by someone else and that someone else is doing the selling. This is a common strategy for companies that have previously raised capital through private placements and now want to allow their investors to sell those shares into the public market. Let's look at a key table here, the offering. It shows that 45 million shares of common stock are being offered by the selling stockholder. After this offering, and assuming all these shares are sold, the total number of shares outstanding will be 59,367539. This is important because it tells us how diluted existing shareholders will become. Remember, when more shares are issued, the ownership percentage of each existing share goes down. This table shows the selling stockholder, AW Digital Asset Opportunities, the 8 LLC, owns 754,594 shares before the offering. But they are offering a massive 450,000,000 shares. After the offering, their ownership is listed as 0. This implies that they plan to sell all the shares they are registering. It also points out that a conversion price of 0.3 per S-share was assumed for this calculation, which is a key detail for how many shares they can actually convert from their preferred stock. Now, let's get to what everyone really cares about from a risk perspective, and Nocera does not hold back here. They start by stating, and I quote, "There is substantial doubt of our ability to continue as a going concern." That is a serious red flag. It means their auditors are worried about the company's survival. They've been losing money. And as of the 30th of June 2025, they had very little working capital, just over $14,000, and a big accumulated deficit of over $21 million. This means if they don't find more money, they might not be able to keep their doors open. They admit they have a limited history and are in a developing industry, which inherently makes future predictions tricky. This is typical for smaller, newer companies. They are basically saying it is hard to know how this will all turn out. This is a crucial point. They are heavily reliant on fundraising. If they cannot secure more money through stock sales or debt, their business could suffer significantly. This is a common theme for companies that are not yet profitable. They need cash to keep the lights on and grow. They also remind investors that the information in this prospectus is a snapshot in time and things can change fast. This is just a general disclaimer, but it emphasizes the dynamic nature of the stock market and business operations. Here is a really interesting part. Remember how Nocera itself isn't getting any money from selling these 45 million shares. This section confirms it. We will not receive any of the proceeds from the sale of the conversion shares by the selling stockholder. They will bear the costs of registering these shares, but the actual money from the sale goes entirely to the selling stockholder. This is important because it means this offering is not designed to fund Nocera's operations or growth. It is about providing liquidity for an existing investor. Let's talk about Nocera's stock itself. They are authorized to issue 200 million shares of common stock, with a par value of $0.001 per S-share. As of the 29th of September 2025, they had over 14 million shares issued and outstanding. They also have preferred stock, including Series B. The common stockholders get 1 vote. Per share, they are entitled to any dividends if declared, but the company does not expect to declare dividends in the foreseeable future. This means any return for investors will likely come from the stock price going up, not from regular income. Specifically about the Series B preferred stock, it was approved in August 2025. It pays a mandatory monthly dividend of 9% annually, which can be paid in cash or stock. This stock is convertible into common stock, but there is a limit. A holder cannot convert if it would make them own more than 4.99% or sometimes 9.99% of the company's outstanding common stock. This is a common regulatory feature to prevent a single investor from gaining too much control too quickly. The Series B also ranks higher than common stock for dividends and in case of liquidation, meaning Series B holders get paid before common stockholders. This section details the private placement that led to this offering. On the 29th of August 2025, Nocera sold up to 13,500 shares of its Series B preferred stock for $910 per share, with a stated value of $1,000 per share. This was done through a private placement, meaning it wasn't offered to the general public at that time. They used exemptions under the Securities Act to do this. The company plans to use the net proceeds from this placement for working capital and general corporate purposes. This section focuses on AW Digital Asset Opportunities V8 LLC, the entity that will be selling the shares. They are the holder of the Series B preferred stock and the ones offering the common stock derived from it. The document mentions they have not had any significant relationship with Nocera in the past 3 years, except for this stock purchase. Here is how the selling stockholder plans to move these shares. They can sell them through various methods, on stock exchanges, through brokers, in private deals, or even by using options. The key takeaway is that these sales might happen over time or in large blocks, which could impact the stock price. They can also sell shares under Rule 144, which is another way to sell restricted securities. This is a behind-the-scenes look at the costs associated with this offering. Nocera is covering expenses like SEC registration fees, accounting fees, and printing costs. The total estimated expenses are around $68,000. This reinforces that Nocera is paying to enable this resale, even though they do not receive the proceeds. This part discusses how Nocera will protect its directors and officers. They agree to indemnify them against certain liabilities that might arise from their duties. This is standard practice in corporate governance, but it is worth noting that the SEC views indemnification for Securities Act violations as against public policy and thus unenforceable. So, while they try to offer protection, it has limits. This is a list of all the supporting documents filed with the SEC. It includes things like their articles of incorporation, bylaws, and various agreements related to their business operations and past financings. It is like a company's legal and historical archive. Now, looking at all of this, Nocera Incorporated presents a really mixed picture. On one hand, they are in the growing aquaculture technology business, which is important for global food security and sustainability. They have a strategic shift from China to Taiwan and are looking to expand internationally, including in the US market. They have a plan for growth and a product that addresses a clear market need. However, the financial reality is stark. The going concern warning from their auditors is a major cause for concern. Their reliance on continuous financing and significant operating losses highlight the high-risk nature of this investment. The fact that this offering is purely for a selling stockholder to exit their position with no cash infusion for the company itself means that Nocera will still need to find ways to fund its future operations and growth from other sources. The dilutive potential of their authorized but unissued shares also poses a risk to existing shareholders. In conclusion, Nocera is a company with potential in a growing industry, but it is also a high-risk venture with significant financial challenges and a pressing need to generate profitability and sustainable cash flow. Investing in Nocera right now is a bet on their ability to navigate these risks and turn their innovative ideas into a financially sound business. Alright, that is our deep dive into Nocera's -1 filing. What are your thoughts on this company and its prospects? Do you see the risks outweighing the potential? Let us know your take in the comments below. If you found this breakdown helpful, please give this video a thumbs up. It really helps us out, and of course, subscribe for more corporate dissections. Don't forget to join our Discord community for more discussions and insights. Thanks for watching, and we'll see you in the next video.